Guys, we have 3 stocks trading at or near their 52-week low. Now remember, the reason we look at 52-week low stock is because they're a great place to start looking for opportunity. These are companies that in the short run have obviously been looked at poorly by the market. If the stock is down a lot, there's probably a reason for it. But the question is it down more than it should be? Let's check these 3 companies out. Stock number 1, and one that has not been on this list in a long, long time, Microsoft. This company is at $3.95 per share, the low of $3.85 back in August of last year. Now, company generates great returns on capital, which means that it gets a good return on the money invested in the business, which is a great place to look for value because companies like that deserve a premium. $3 trillion market cap, revenue of $260 billion, free cash flow of $70 billion last year, $62 billion in the last 5 years. One thing I don't like is it's very different than its net income and 5-year net income. Substantially lower than that. But for a company like Microsoft, am I as worried about that? Not necessarily, but I still want to understand why that is. They might be making a lot of investments into the AI space with all the data centers and things like that. This is a company with a very high gross margin, 70%, and bottom line margin about half that. Incredible. Money printer. Let's go check out the 8 pillars on this company. All right, it's what we love. 6 checks, low debt, high returns on capital, buying back shares, hopefully intelligently, growth in free cash flow, net income, and revenue. But we have the issue of valuation. Our 2 valuation metrics look high. Now remember, just because they're X's doesn't mean they're overvalued, because there are multiple things that go into valuation, one of which is growth. Yes, growth is a value metric. People have a hard time understanding that. But you can underpay for a company that's growing 100% per year. And you can overpay for a company that's growing 3% per year. But understanding those differences. Now, Microsoft, that $3 trillion powerhouse, is absolutely dominating cloud computing, AI, and gaming. Microsoft's revenue comes from 3 key areas. Productivity and business, things like Office 365, LinkedIn, and Dynamics. Intelligent cloud, like Azure, SQL Server, and enterprise services. And personal computing, Windows, Xbox, search ads, etc. Now, Azure led the way, growing 22% last year, while AI is projected to bring in $10 billion annually. Now, that's not a lot right now. It's about 4 or 5% of the revenue, but it's growing. Now, the CEO, Nadella, has transformed Microsoft into an innovation machine with strategic acquisitions like LinkedIn, GitHub, and Activision Blizzard, strengthening its ecosystem. Last year, Microsoft generated over $200 billion in revenue, reinvesting heavily into AI and cloud. At almost $400 per share, it's not necessarily in bargain territory, trading at a premium on the AI hype and earnings growth. But a great company, at this price, patience is key. The question is it the right price? Let's go see what analysts think about the pricing for Microsoft. Guys, look at this. Look at this growth in earnings per share. $13.30 to $23.50, 11%, 14%, 17%, 15%, 14.5% per year for a $3 trillion company. Revenue growth, 13%, 14%, 15%, 15%, 12.5% for a $3 trillion business. This company deserves a premium. That's what the stock analyzer tool does. We made this tool specifically to put these 2 things together. Because remember, if you buy a company just on the story, you're probably going to make mistakes in the long run. If you buy companies just on the numbers, you're probably going to miss out on a lot of opportunities. So let's pull up the last time I did Microsoft to see what the numbers look like. Guys, on a 10-year analysis, and you can do up to 20 years here, I did 6, 9, and 12% revenue growth. I did profit margin of 32, 34, and 36. I did that lower free cash flow of 28, 31, and 34. But in all likelihood, especially for a company like Microsoft, free cash flow and earnings will probably equate out at some point. PE. What are the multiples you should put on the earnings and free cash flow? I put 20, 23, and 26. It has a lot of growth potential, high returns on capital, and it's got its own moat status. Is 23 too low for the middle? Maybe. I could understand somebody going higher. Is it too high? Maybe. I could understand somebody saying 20. Now, if somebody said 15 to me, I'd say, you're crazy. That's insanely low. So I hit the analyze button. Boom. I have a low price of $225 to $260, high price of $530 to $560, middle price of $350 to $380. Guys, for me, I'm just waiting. I have my watch list at 325. It doesn't mean I'm buying it at 325. I'm going to get a notification if it hits 325. I can run my numbers again and either decide to buy it or sell puts to be able to generate income while it falls. That's a very important part to my strategy. Guys, stock number 2, Atkore. Now, Atkore is sitting at $62 a share, all-time high of $195 back in April of last year. So literally 11 months ago, it was at $195. It has fallen now 60-some%. That's a huge drop. Now, this company generates only 31% gross margin. Some of the things I like about it, look at this. PE of 5.7, price of free cash flow 6.8. Look at these returns on capital. 27% over the last 5 years, 17% last year, high returns on equity. I mean, I look at this saying, what's the deal? Why is it selling so cheap? What's the story about it that everybody just is selling so cheap on it? It even has a 2% dividend. So let's go check out their 8 pillars real quick. 8-pillar thriller. Everything here is a check. 5-year PE of under 4, 5-year price of free cash flow a little under 5. Buying back a lot of shares. 26% of their shares in the last 5 years they've repurchased. That's a great way for a company to add value back to their investors by saying, listen, our stock is so cheap, we're going to take our cash flow and buy back shares. Guys, why are they spending $46 million a year on dividends? They should cancel that dividend and keep buying back these shares that they believe in the company. Now, Atkore makes essential but unsexy products, electrical conduits, cables, and security infrastructure. They operate in 2 key segments: electrical, which is the bulk of their business, supplying conduits and cables for construction, and then safety and infrastructure, metal framing, pipe solutions, and security barriers. Revenue hit $3.2 billion in 2024, but that's down 9%. Not ideal. But the bright side is they're still profitable with $376 million in net income and a stellar 25.5% return on equity. At $65 a share, Atkore looks cheap, but declining revenue is a red flag. If sales are able to stabilize and continue to grow, even if it's a low level, this could be a great opportunity to buy a company that everybody could be overreacting to. But until then, you have to do your research to make sure you understand what you're buying. That's the 3rd pillar in our principle-driven investing. If you don't understand it, don't buy it. Let's see what analysts think about this company. Here's what's interesting, guys. Yes, year over year, profits down 57%. But look at this. They have it growing from here, 5.5% and 15%. With revenue, even though it's down 9.5%, back to growth. Not huge levels of growth, but growth nonetheless. Now, guys, here are my assumptions on Atkore. I'm going to do a 10-year analysis. I did 20-year before. I'm doing -4, -2, and flat revenue growth. That's absurd. Let's actually change this. This is what I did before. Let's do -3, 0, and 3% revenue growth. Let's just assume in the middle section, they just keep going at current revenue. Profit margin, I did 8, 10, and 12% for both profit and free cash flow. Let's assume that they're going to be even lower than their recent numbers. Okay, PE, price of free cash flow, 7, 9, 11. Guys, high returns on capital, buying back shares. This is a company that should get more than 7, 9, 11. Let's go with 9, 12, and 15. 9% desired return. You hit the analyze button. Now remember, guys, Stock Analyzer tool has been used over 1 million times in the last year by our community members. Why? Because it allows you to take the story and the numbers and put them together and find a price that works for you. Trust me when I say this. Whenever I think about a company and see the stock declining, I go to Stock Analyzer tool and I run the numbers to validate my assumptions. This tool alone, and yes, there are many tools in here to save you time with investing. It's the most shared aspect of our software in our community. The thousands of members in our community who are trying to become better investors sit there and do that. This channel is about teaching people a process. How you apply that process to your investing is up to you. But the big key for us is finding the people in the community who are smart for the community. If you've made it this far in the video, you're probably in that group. The question is, are you ready for it or not? Now, the good news is we have a 7-day trial. It allows you to dip your toe in and see the benefits of the software for your own personal investing. Remember, there'll be tough times in the market. You're going to want to surround yourself by like-minded people when those tough times occur. You want to be part of a community so you can bounce those ideas off people. So if you're interested in trying it out, click the link in the description below and try it out. Now, 9% desired return. Again, it's the intrinsic value. Hit the analyze button. This is why this company is interesting. Low price of 56, high price of 160 at 0% revenue growth for the next 10 years. It's a potential 16.5% return, including that dividend. This to me says you got to at least take a look at this company, because I was conservative all the way at the top. On my middle assumptions, I still got the 16.5% return. Stock number 3, a company that I personally own, don't buy it just because I do, Target. This company's gotten, oh wow, 126. Guys, here's proof. I own a company, I had no idea what the stock price was at. I have no freaking clue. But what's interesting here is I do know that this stock is interesting to me at 126. Again, don't go buy it. Let me show you why I think it's interesting. First off, I don't think Target's going away. I think Target's adapting very well. My sister-in-law and other women I know say, I love that Target does a great job of same-day delivery, easy pickup, etc. That's what's going to keep Target around. They're doing things like having Ulta Beauties and Starbucks in their stores. It's a great go-to. This company is also paying a huge dividend of 3.5%. Why? Because of its stock price. Guess what? This free cash flow is pretty solid, $4.5 billion a year. Decent returns on capital, 14% over the last 5 years, 12% last year. Now, this company right here, no acquisitions. So this growth right here, 3, 5, and 10-year growth is all organic. And guess what? As time goes on and we have inflation, their revenue is going to continue. They're opening more stores and they're being smart about that growth, in my opinion. Let's go check out these 8 pillars, see what they look like. All right, we have one X, and I don't think it's an X. It's our debt level. But why? Because they have leases. So I don't really consider this an X. I consider this basically a check. So I look at this as an 8-pillar company. These pillars tell me a story. One thing is buying back shares. You're looking at a company with a 5-year PE of 13, a 5-year price of free cash flow of 15, 1-year price of free cash flow of 12.8, and the same on their PE in the last year. I'm looking at this going, damn, this company, could it just be overlooked? Now, Target's down about 9%, 8% this year, just above its 52-week low of 120. So is this a value deal or is it a value trap? Now, Target isn't Walmart, but it's also not a fading mall brand. What's its strategy? Affordable, trendy, convenient. A big move this year was partnering also with Warby Parker to bring vision care to stores. Guys, they own $10 billion brands, including Cat & Jack and Good & Gather. But retail is ruthless. Between inflation, e-commerce, shifting consumer habits, adaptation is key. Third quarter of 24, $25.67 billion in revenue, slightly up, and net income of $854 million, down from about $1 billion. Margins are tightening. They had a lot of issues with theft. They're working at that. But at 13 times earnings, Target isn't expensive. But if profitability keeps sliding, it's not a steal either. I love strong brands, but I love cash flow more. If this dips further, it could get even more interesting. Now, I started buying Target under 135. Let's see after the stock analyzer tool here if that's a reasonable price. Now, here's what's interesting about Target and earnings per share assumptions by analysts. $8.80 this year, growing to $14 in 2030. That's a big jump for a company that might be struggling. Revenue growth, $107 billion, growing to $130. 2 to 4, 5% revenue growth a year, which is about right? I mean, maybe a little bit better. Now, are analysts right on this one? I don't know. But I look at Target thinking, what are the chances that Target is gone in the next 10 or 20 years? What kind of world does that look like? So guys, next we got to do is merge the story and the stock price together in stock analyzer tool. Here are my assumptions on Target. I put a 10-year analysis, 2, 3.5, and 5% revenue growth. Profit margin, 375, 425, 475. Same with free cash flow. PE, I did 15, 18, and 21. Now you might sit there and say, well, Paul, it's only 12 or 13 times. I know. But to me, they have above average return on capital, and it's a great brand. I think that deserves a premium. So my 9% desired return, I hit the analyze button. And guys, before I show you guys the numbers, please watch our next video, which is the 3 best deals in the market right now. If you're serious about value investing, finding great companies at great prices, you have to watch this next video because the market is full of overpriced hype. But real value investors know that the best opportunities come from great businesses trading at a discount. So as soon as I'm done with the stock analyzer tool, click this link to go to that next video. Trust me, you'll want to hit it. So I hit the analyze button. Boom. I have a low price of basically where it's at today, high price of 240, middle price of 175. Remember, these current returns include their ample dividend. Guys, go check out the next video. Thank you for your time.